Hello, and welcome to today's webinar, 5 little-known but powerful metrics every credit union should measure. My name is Dennis Sullivan. I'll be your host for today's webinar, and we are very excited to have with us today Tim Harrington. Tim is in the unique position of both having the financial background and the credit union background to give us some information that you may not always hear or pay attention to, in fact, in your credit union. We challenged Tim a little bit with this topic today to talk about some of those metrics that credit unions may not always be following, but should and can deliver a powerful impact on their credit union. Tim is a leadership expert, a gifted speaker, instructor, author, consultant. You can also add painter in there if you follow him on Facebook. Since 1996, Tim has been the president of Team Resources, a firm that provides strategic planning, training, and consulting for credit unions nationwide. Prior to that, he was a large partner in a large regional CPA firm that is now known as Clifton Larson Allen, and the president of Connelly Manufacturing. Tim was chairman of the board of the $150 million Tucson Old Pueblo Credit Union in Arizona from 2002 to 2006. During that time, interestingly enough, the credit union evolved from losing more than $2 million a year to earning nearly $2 million per year. And today's webinar is brought to you by the National Directors and CEOs Leadership Convention. We hope to see you all there this August, but what we're doing here is something a little bit different. It's our 40 for 40 series. In honor of our 40-year celebration, we are working to bring you more content throughout the year instead of just 4 days in the first week in August in Las Vegas. So we're excited to bring this to you today. We hope to see you in Vegas. Tim is going to be one of our featured speakers. He is ranked as one of our all-time highest rated speakers, so we're excited to have him here today. And without further ado, Tim, why don't I turn it over to you?
Well, Dennis, thank you very much, and hello, everybody. I hope you're having a wonderful day where you are. It's a lovely, cloudy day here in the deserts of Arizona, and our office is in Tucson, Arizona. Beautiful, about 85 degrees. So we're enjoying the slightly cool weather before the heat hits. And it's always an honor to be part of the National Directors Conference. I think I've been a speaker there for 14 years now, and it's just such a treat to be part of that and to meet all the people I get to meet there. Now, you as someone in a credit union measure lots of things. There's lots of things we measure, and there are lots of measures that are common. But a couple of measures or a handful of measures I think people should pay more attention to that aren't used that often. And the first one here is the efficiency ratio. And so I'm the accountant type here. I come up with the details. Dennis Sullivan, who introduced us here, he's the creative genius behind the graphics here. And I love this first graphic. I love that great white shark with its mouth wide open, because that's a real good picture of what we're talking about here. It's really about the efficiency ratio measures, I suppose, a number of things. What I'm looking for is this. What percent of your income is eaten up by your operating expenses? And are your operating expenses a great white shark eating up a lot of your income, or your operating expenses a little sand shark just eating up a little bit of your income? And the difference is important. So the efficiency ratio looks at the percentage of income eaten up by operating expenses, as well as the dollar amount of operating expenses spent versus revenue earned. So there's several ways to look at this, and the simplest way to look at it this, when you see the percentage, you're going to, with an efficiency ratio, you get a percentage. It tells you how much it costs you in pennies, in cents, to earn $1 in revenue. So let's go ahead and look at how the efficiency ratio is calculated. We take our income statement. Now, you always have to work with an annualized income statement, 12 months of income to make this work. So we have a 12-month income statement here, and I'm going to show you the equation to get the efficiency ratio. It is operating expenses divided by controllable incomes. Now, you might be aware of the fact that NCUA has a ratio of operating expenses to gross incomes. It's on their financial performance report. It's been shared for decades, and I don't think it's a useful measure. As a matter of fact, I think it can even be sometimes a dangerous measure, because what their measure measures is your operating expenses divided by your revenue from loans and investments, your interest income, and your other incomes. The problem with that is if interest rates ever fluctuate again, as interest rates rise, your revenues increase, but it didn't really have to do with you doing anything. Your operating expenses didn't change, so your efficiency ratio would improve. As rates drop, your revenue on loans and investments decreases, and you didn't do anything there too. So their measure fluctuates wildly as interest rates fluctuate. They haven't fluctuated much in 10 years, so it hasn't been a big issue, but they're starting to move again. What the efficiency ratio does is it takes out the impact of rising and falling interest rates. And how it does it is by this term called controllable incomes. So right below that you see controllable incomes are the net interest margin and your non-interest incomes, fees and service charges, all your other non-interest income sources. So what is the net interest margin? That's our next line here on the equation. It's your interest income minus your cost of funds. It's your interest income minus your interest expense. That gives you a relatively stable number to work with in a rising and falling rate environment. The interest income, your net interest margin and your non-interest income are called your controllable incomes. We don't really control them as well as we'd like to. We manage them, more likely is the term, but it isn't affected by the whims of the marketplace. So once we do that, we need to get our numbers. And where do we get them from? The operating expenses here have a big red arrow going to $7,800. The operating expenses are people, buildings, and systems. It doesn't include the provision for loan losses. That's pulled out of it. So we take our people, buildings, and systems, and we divide that by our controllable incomes. And our first controllable income there is our interest income from our earning assets, our loans and investments, $17,000 in this example. Now that would fluctuate with the changes in the interest rate environment, so we have to moderate that by subtracting out the cost of funds, the cost of dividends paid on our deposits. That little piece right there gives us the net interest or the net interest margin, that relatively stable amount between interest earned and interest paid out to our borrowers. So we take those two items and we add to it our non-interest income. And a non-interest income is made up of fees and charges and other non-interest sources. So we take that numerator, divide it by that denominator, and in this case we get out 7,800 divided by the combination of 17,000 minus 8,700 plus 1,900, and we get a percent. In this case, the percent is 76.5%. Now, any static number is not that useful. You want to know the trend in that number, but that static number, you want to know if that is good or bad or ugly. Well, it depends on a number of things. And so that's why I like to look at trends. So here on the next slide, you see a credit union's 5-year, 6-year history of their efficiency ratio. And I want you to know that the efficiency ratio is a lower the better score. The lower the number, the more efficiently you're using your resources. So in this case, the credit union has gone from 67% efficiency ratio, quite an extraordinary efficiency ratio, honestly, up to 80%. Well, let's talk about this in real simple terms. What does this mean? It means that way back in 2012, it cost the credit union 67 cents to earn $1 in revenue. At the end of 2016, that had risen to 80 cents to earn $1 in revenue. Now, obviously, the ratio is going the trend is going the wrong way. So that's one thing that this indicates right away. And the other thing is why? Why is this happening? Well, two things affect this. Your cost of operations on one hand, and the incomes or revenues you're earning on the other hand. In this case, what has happened at this credit union is that their revenues have declined. Their loan to share ratio has declined pretty significantly. So they're taking money out of loans earning 4.5%. Not able to make that loan, they have to reallocate it to investments earning 1%. Their revenue has come down pretty dramatically. Their cost of operations at the same time has grown a little bit because of a new branch. Those two things combined have really squeezed the credit union. They aren't as efficiently earning revenue. Now let's go back to a question. One of the questions that was posed before this even started was people sent some questions in, and it had to do with our not-for-profit status. You know, how do we explain a not-for-profit status and profitability? Well, the point is, our not-for-profit status is not our financial goal. It is our tax status, which means because we do good work for people and there's no individual investors benefiting, we don't have to pay taxes on our income. That's all it means. But we do have to make a lot of income, a lot of profit. As a matter of fact, most credit unions have to make as much profit as banks do just to survive. Now, banks have to make a profit because they have to pay their investors. Our purpose is different. All of our capital comes from profit. We're going to get to capital in just a second, but if we don't make enough profit and we're growing rapidly, we can't build capital fast enough to keep our capital to assets ratio stable. So if we're growing relatively fast, and most credit unions right now are growing relatively fast, they need a lot of profit. Now, the efficiency ratio doesn't tell you how much profit you're getting. You have ROA for that. But what this tells you is it harder or easier for you to make a profit? And in this case, it's harder and harder for this credit union to make a profit because they aren't as efficiently turning costs of operations into revenue earned. And keep in mind, the profit isn't taking advantage of members. Profit is about providing great value. We can be, my fastest growing clients, the ones the members love the most, also are generally the most profitable clients. And why is that? Because they're giving great value. They're making an efficient use of resources and getting a fair return on what they charge for their services and products, for their interest rates, fees, etc. And the market loves them. And then you have that money to turn into something else. Now there's another element on this page, and it's called compensation to income ratio, and that's one element of your efficiency ratio. So in this case, you'd want to look and say, is our cost of people a negative contributing factor here in our efficiency ratio? Now I do have some peer information here, and the peer information says that the peers are 80%, so this has gone just from extraordinary to average. And cost of people has been a little bit higher here. So the cost of people is now 43% of the income they're earning, where the average credit is 40%. I don't like peer information. I'll tell you some more about that in a little while, but it does tell you if you're on or off track sometimes. So let's go ahead and look at the next example. This is a credit union that's recently really improved their efficiency ratio. They were very high back in 2012 at 84.75%. Now for their asset size of 125 million, they're way ahead of the game. And how did they do it? Well, they didn't so much focus on their cost of operations. What they did is they realized they just weren't generating the revenue they needed. They were much too conservative. They had been battered about in California by the Great Recession, and they were very conservative in how they made their loans. The problem is when the economy improved, they didn't wake up and improve and expand with it. Once they woke up and got the loans out the door, got aggressive in lending, and put really a lot of good loans on their books through aggressive lending and buying some participations, etc., you can see that their revenue increased dramatically. Their operating costs didn't change, but their revenues were increasing so dramatically that their operating costs were now generating a lot more revenue, bringing their efficiency ratio down and down and down. At the end of December, it was 66.7%. These guys are in good shape. Now, the efficiency ratio is just one tool in your toolbox. I have one client whose entire strategic planning process is all about bringing their efficiency ratio down. Now, that was about 8 years ago, and at that time they started at 74%. Today they're at 56%. $2 billion credit union, 56% efficiency ratio. They're much better at earning revenue with the costs they have. It has to do with sales. It has to do with connecting to members and engaging members. It has to do with making members full members as opposed to one product customers that come and go. So it's just one tool to measure it, but it's a really important tool. Now look at the next page, and we see that it does, the average does vary tremendously with size. So economies of scale are a real issue here. When you break it down to the large credit unions over 500 million, the average efficiency ratio is 69%. By the time you get down to a $10 to $50 million credit union, it's 86.7%. So smaller credit unions in that sense are at a disadvantage. They have other advantages in personal service, but as far as their internal costs and the revenue they generate, they are at a disadvantage. And it's usually both elements, that their costs are a bit higher because they're trying to spread products and services over fewer members, and they want to have a lot of good products and services. On the other side, they tend not to sell or engage their members as well, so they don't get as much revenue per member connection. But this question that I'm asking here, and go back one more slide if you would, this question that I'm asking here is, if it costs you 75 cents to earn $1, but it only costs another credit union or a bank down the street 69 cents to earn $1, over the longer term, who's going to have the advantage here? That's a really important thing to think about. You want to use your assets. You want to use your people. You want to use your systems efficiently and get the most return from them. And before you go to the next slide, I'll have to tell you a story. So Dennis mentioned I was a partner with a firm that's merged several times, and today it's known as Clifton Larson Allen. But our partner in charge many years ago was Ron Parker, and brilliant guy, head of the AICPA Credit Unions Committee, wonderful guy to work with. And he and I shared a lot in common. We were both from small population states. I'm from Montana originally. He's from South Dakota, and we knew a lot about farming. He was raised on one, a lot about ranching. And we were talking one day, and he said something to me that it's just good old homespun wisdom, but it's brilliant. And he said, Tim, my daddy told me a long time ago, don't buy anything unless it has babies. Well, I thought, what's that all about? And I thought about it, and I thought, well, sure. You don't buy a bull, you only need one of those. You need a lot of cows. You don't buy a rooster, you only need one of those. You need a lot of hens, because they generate growth. They generate the revenue for the organization. So one of the things that was also asked, came up several times in the pre-questions, was ROI, return on investment. Sometimes it's hard to calculate, and the question was mainly about ROI for marketing. But you got to make sure that whatever you invest in gives you a return. It's got to return, unless it's for regulatory purposes, it's got to return more than it costs. So let's go to that next slide now. So how do you change it? You either reduce costs, or you increase revenues, or you do both. But I do suggest monitoring this, because this is what keeps you competitive or not competitive in the end result. So what's our next measure? It's one we all know. And the next measure is your capital to assets ratio. It's a gauge. And how do we use this gauge? Well, for directors, it's really important to make it simple, that they know it's our stability account that grows with profit, that shrinks with losses, and the measurement of capital to assets or net worth ratio is a percent of asset size. And what happens if we don't grow capital as fast as we grow assets? Well, that's the next slide is going to tell us. It's going to tell us we become unstable. If assets grow faster than capital, we become unstable. So we want to monitor this over time. And I love the next slide, because it's got that scary picture of Robert De Niro saying, I'm watching you. What do we watch? We want to watch this gauge over time, quarter by quarter and year over year. And what we want to see is, which direction is it going? Which direction is this gauge going? So let's go ahead and look at that next slide, and we'll see this nice simple analysis here. The green line is the trend line in your net worth ratio or capital to assets ratio over time. If it's going along flat, it means you're producing profit fast enough to keep up with your asset growth, which keeps your capital growing in line with your assets. If the green line is increasing, going from 10% to 12%, we're actually producing more profit than we need, and we're building capital. But what we want to watch out for, both the management team level over time, not necessarily month to month, but over a longer period, and certainly at the director level, is if that capital to assets ratio is declining over time, it means we're growing too fast for our contribution to capital. And that contribution from capital always comes from profit. And what we're doing if we see it decline over time is we're living off of old capital. We aren't earning our own way right now. We're living off of capital earned in earlier days to keep us alive today. It's a support system. So let's monitor that gauge, and it has to do with our next slide as well, and that's the return on equity. The return on equity is very, very important for banks to pay attention to, because banks, it's what it is, it's a measure of your net profit divided by your total capital. Profit divided by equity. It'll give you a percentage. So in a bank, it tells you how efficiently you're utilizing your capital, and as a bank investor, that's my capital. I want to get a return on it. What percentage return am I getting? Is it 4% or is it 14%? And the difference has a lot to do with whether I'm going to keep my investment in that bank or not. We don't have investors like that. So what does it mean to us? Here's what it means to us. It tells us the maximum speed that we can grow assets at our current rate of profit and still maintain capital. So the next slide shows a 6-year trend in that. The most recent says 2.63%. And what that means is that this credit union at their current ROA rate, which is 34 basis points, can only increase their assets 2.6% at that profit rate. If they grow assets faster than that, what's going to happen? What's going to happen is what you see on the next slide, and that is, back to that capital to assets ratio again, their capital to assets ratio is going to fall. So let's go ahead and see that next slide. If we outpace our asset, if our asset growth outpaces our profit, then we're going to see that red arrow going down. So the ROE, return on equity, which is a little percentage as a point in time, it's capital divided by, it's earnings, annualized earnings divided by total capital, will tell us the fastest pace we can grow assets at our current profit rate without causing our capital to assets ratio to decline. And that's an important thing to watch. If you don't want your capital to assets ratio to decline, you know your profit rate, you better watch your ROE. So let's go to the next concept here. We're leaving capital and earnings behind for the moment, and we're talking about an allocation of resources, measuring some type of allocation of resources. And this has to do with our gradual conversion from inhuman branch delivery systems as the main focal point to remote delivery systems, mainly mobile and contact center, as our main focal point. So we measure the percent of operating costs allocated to branches and those branch users versus mobile, web, and call center and those users. And what woke me up to this was about 4 years ago, one of my clients in a large city said, we figured out that we're spending 75% of our operating costs, which are mostly for branches, those are branches right there, on 5% of our members who use our branches. So that kind of woke me up to it. Now, I don't have actually a good measurement for you on this because gathering the information for this is very difficult. But I want to share with you a concept, and I want you to go ahead and give this concept a try. Break it out, and if you get a good measurement, send it back to me because I'd love to be able to share this more often. But here's the concept here. So we have 26,000 members, and from what I can see from member usage, we can estimate that about 4,500 of those members prefer mobile and web. They predominantly use mobile and web, mobile and internet transactions with the credit union. About 7,000 more predominantly use our contact center. So that makes up 44% of our members right there. About 8,000 of the 26,000 members, or 31%, predominantly use the branch. The rest of the members, they don't use us all that much. Now we look at the allocation of resources. How much of our resources are dedicated to remote delivery systems and the staff dedicated to remote delivery systems? That would be mobile, internet, that would be the ATMs, that would be contact or call center. Well, in this case, 44% of their members use things remotely, but only 25% of our dollars are allocated on the to those systems. On the other hand, our branch costs and the staff dedicated to branches is 65% of our operating costs, but only serves 31% of our members. And when you break that down further, that 31% of your members, a very large proportion of those are often low balance transaction members who don't have a big contribution that they're making to the credit union. So we tend to spend most of our dollars on the people who actually bring the lowest contribution to the organization. One of the things we always have to remember is we're a cooperative financial organization, a cooperative bank, so to speak. And that means that every member is an owner, and every member therefore has an obligation to help us be successful. And the ones we tend to serve the best are the ones who have a direct deposit check into their payday, into their checking account on payday. And then they come in and take most of it out. They fill up our branches. They use lots of human time, which is very expensive, and they don't really have balances with us. Now, maybe they bounce a lot of checks, and we make money off of that. You have to keep that in mind. But what if they don't, and they don't keep big balances? We are a business that either depends on big balances from members or lots of fee income generated from members. But if we don't have members who do one or the other of those are abusing members, not contributing members. So the idea behind this is, look where your contributing members are, look where your growth needs to be, and make sure that where you put money is properly allocated to both what the market wants and what you need to do for the future. And that's to the next slide around. That's my rules. Know the rules. Here's Tim's 2 rules to keep in mind. The allocation of resources is all about what matters most is what the market needs. So what does your market need? Remember, you have multiple markets there. The older demographic, the lower income demographic, the younger demographic, the higher income demographic. You have lots of breakouts in that. And don't just do something because someone else is doing it. Do it if your market needs it. But for most of us, I think it's important to look at this as best as we can measure it, this allocation of resources, and then determine, are we allocating this properly? Is this really, we want to put this much into branches and branch transactions when our real profitable or contributing members are actually the mobile and the internet members and the younger member we're trying to attract? Those are the processes we have to go through, always keeping in mind we're there for service, not for profit, but we have to constantly balance those two. Now let's go ahead and move to our last metric here. And it's one that most folks don't think about all that much. And it is a minimum asset growth rate. Now there's a lot of folks out there talking about the importance of growth. You've got to grow. You've got to be over 500 million. You've got to be over $500 million. And you can see there are benefits to that with the efficiencies of scale. But what's most important, I could talk all day about both the benefits of growth and being larger and the benefits of being small and nimble and having a clear strategy. There's good sides to both. But I do have to make sure that credit unions know that there is a minimum growth rate, and below that minimum growth rate, the credit union is actually shrinking. And what is that minimum growth rate? Well, it has to do with 2 things. One is the inflation rate. If you aren't growing as fast as inflation, you are in fact shrinking because the value of each dollar is eroding. As of January 2017, the inflation rate was 2.5%. So you have to grow at least 2.5% just to keep your asset side growing with the inflation rate. But on top of that, you're paying your members money. So you're increasing your size by the dividends you're paying your members. And so the national average dividend rate, deposit rate, was 53 basis points. So the minimum asset growth rate is the inflation rate plus how much you're putting into yourself as deposits that is not really exterior asset growth. It's not outside money coming in. It's just inside money being put into your members' accounts and typically being retained there. So the combination of the two is your minimum asset growth rate. Right now, it should be about 3.03%. Anything below that, you're shrinking. Anything above that, you're growing. So it says here in the red, if your assets and loans are growing slower than this, you are actually shrinking. And while the value of growth is debatable, the danger of shrinking is pretty darn clear. Now, the other side of that, too, is growth indicates satisfaction of members. If you're growing, it means people are bringing more business to you. It means people are telling other people about you who are bringing business to you. Profitability. Profitability isn't about taking advantage of the members. Profitability is about bringing true value to your members. So some things that I want credit unions to pay attention to, there are things that I think are very important. One is the efficiency ratio. How efficiently are we using our resources to earn revenue? And earning revenue, earning profit is extremely important to us. It's looking at our capital to assets, our net worth ratio, to monitor it over time to make sure we aren't living off of old capital, that we are profiting and building capital at least the same pace that we're growing our asset size. It's return on equity, which tells us what that asset size growth rate could max out to be at our current profit rate in order not to see our capital to assets ratio diminish over time. It's looking at the allocation of resources between what we're allocating to remote delivery and remote delivery users, what we're allocating to in-person branch delivery and the in-person branch users, and making sure that we're actually putting our money in the right place, which is where it's best for the future of our organization. And lastly, how fast are we growing? Are we growing fast enough to keep ahead of shrinking? And right now, that's right around 3 percentage points. So there are many things to keep in mind. Please feel free to contact me. My contact information is right here. And Dennis, I'm going to pass it back to you.
Thank you, Tim. I appreciate you going through that. A lot of information in a short period of time. Really did put Tim to the challenge there, coming up with some metrics that perhaps credit unions may not always be following, but should. So hopefully this was helpful for you. Perhaps consider some other metrics that you're not considering now that could have an impact on your credit union. And I want to thank Tim for taking the time putting this together. Hope you found it helpful. Tim's email information is here, as well as his phone number. He welcomes calls, emails. We weren't taking questions today, but if you'd like to follow up with him, please feel free. And once again, we hope to see you at the National Directors and CEOs Leadership Convention. Tim will be there with lots of good stuff that he's prepared to share. He's going to be doing a pre-conference workshop and sharing even more of this for several more hours where you can really dive deep into the topic. And we hope to see you all out there. We have a special discount going on right now for a short period of time. So go to cudirectors.com if you haven't already. And we look forward to seeing you in Vegas. And Tim, look forward to seeing you in Vegas as well.
Dennis, thanks very much. Thanks, everybody.
Take care. Bye-bye.